Let's just start there, Brian, if we can. The willingness of central bankers to allow yields to drift any higher than they already have done. What's your view on that now, Brian?
Well, good morning, Jonathan. Great to be on Bloomberg. And so I would say this, our great economics team continues to believe that the Fed is going to be on hold through 2022. I realize that is consensus. But I think we need some perspective here, okay? The 10-year Treasury over the last 50 years is 5%. And I think we're looking at relative moves due to really a natural disaster, which is the way that we're kind of looking at what happened in 2020, not a recession, not a black swan, but a natural disaster. And the fact that we're still below 2%, let alone below 1.5%, I think it's always dangerous for equity people to make fixed income calls. But our call continues to look at, as long as we're below 150, we don't have to worry about a massive correction. And correction themes in the market seem to be the shizzle my nizzle right now in terms of all the rhetoric. So listen, prices are rarely linear for long in markets, as you know. We're in kind of a news vacuum on fundamentals. I believe that fundamentals drive stocks, and I wouldn't be surprised if we see a little sideways to down action, but that's going to be healthy, especially considering the type of move that we've seen in stocks, Jonathan.
Brian, I just want to know how much someone paid you with that bet to get you to say for shizzle my nizzle on this program with me in the last 30 seconds. You clearly won. I just want a cut of whatever you got.
Well, they pay me more for doing this than saying shizzle my nizzle. So,
Stuart, let's bring you into the conversation. Did any of that resonate with you?
Good morning, Jonathan. I think it all resonates with us. I think, the challenge here, from the Fed's perspective is they've committed to basically allow the economy to run hot. And the market's reaction to that has been to move yields higher. So sort of a victim of their own success to some degree. From an equity perspective, the inflation trade, I think, is generally quite positive for equities until you get to levels that approach, call it 2.5%. So we've gotten sort of the bottom end of the range that would start to get equity markets' attentions. When break-evens got up to 2.25 last week, I think it did get equity market attention, and we've then seen break-evens back off a little bit. Real yields is a little bit of a harder thing to decipher, in my opinion. The beta to real yields for equities has been positive for most of the last couple of years, but it tends to be a pretty unreliable indicator, and it was actually negative from 2016 to 2018. So I think the question there is, does the positive beta kind of continue? And if not, do we get this kind of phase shift, which I think could be kind of disruptive for equities? Because if you look at rate-sensitive equities, you're basically buying value and selling quality, which is basically, essentially the opposite of what the consensus market portfolio is here. So, we are, I think, at tricky levels for both for break evens, and I think it wasn't the level of real yields, but frankly, the velocity of the move the last couple of weeks that got disruptive. And if that starts to calm down, I think we should be resuming the upward trajectory.
Brian, there's this big conversation about higher inflation coming back, a return to normal. I noticed that you push back against that, the return to normalcy, the idea that we get this inflation surge as well. Why, Brian?
We do, and I think the number one thing people are missing on the inflation side of things is they're discounting Ms. Yellen's comments with respect to full employment. Remember, man, a year ago, we were sub 3% unemployment, right? Sub 3% unemployment, and Ms. Yellen says we're going to try to get to full employment again. That's going to take several quarters, if not years. And so I think until we start to see weekly jobless claims drop precipitously, then we can start talking about inflation. With respect to what's happened in the normalcy side, when we wrote our year-ahead piece in November and put out our 2021 forecast, we cautioned everyone, just because the calendar's changing doesn't mean 2021 is going to be any different than 2020. And so far, from a societal basis and what's happening with the vaccines, that's exactly what's happened. Yes, there's some debates with respect to when herd immunity is going to happen, but clearly there's going to be issues, and this is going to take longer to have people walk from Port Authority to their offices in Times Square, get on a train, get on a plane. Yep. It looks like more to us that we're going to see more reality into 2022.